Hello everyone, welcome back to Safe Stock Investments. JK Lakshmi Cements delivered a strong volume growth and a sharp recovery in pricing, but rising fuel and raw material costs continue to pressure margins. With capacity expansion, improving volumes, and long-term earnings growth ahead, is this a buy opportunity? Let us analyze the numbers and the investment outlook of this company. JK Lakshmi Cement started financial year 27 with a healthy operating momentum as consolidated revenue increased 9.4% year on year, supported by 8.2% volume growth. However, profitability moved in the opposite direction, with EBITDA declining 16.9% and EBITDA margin contracting by 430 basis points. The key reason was a sharp increase in input cost, particularly raw materials, fuel, and packaging. Despite this pressure, the company delivered better than expected volume and stronger pricing, helping revenue outperform the analyst estimates by 8.5%. For investors, the quarter highlights an important contrast. Demand and pricing are improving, but cost inflation is temporarily absorbing the benefits of EBITDA level. One of the most encouraging development is the improvement in pricing. Blended realizations increased 8.5% sequentially and 1.1% year on year, supported by better pricing in North and East markets, strong non-trade contributions, and geographical optimization. The company has also reduced its average lead distance by approximately 5% sequentially, creating an additional logistics benefit. Around 90% of sales are concentrated in core markets, allowing the company to optimize its geographical mix and logistics cost. July and August prices remained broadly stable, while management continued to pursue price increase as demand improves. This is important because sustained pricing improvements will be essential to offset elevated fuel and raw material cost and restore EBITDA margins. The immediate pressure on earnings is clearly coming from the cost side. Raw material cost increased 30.5% year on year, while power and fuel cost rose 13.2% and other expenses increased 23.7%. On a pre-ton basis, raw material cost increased 21%, while power and fuel cost increased 5% despite renewable energy accounting for 49% of the total consumption. Packaging costs are also expected to remain elevated. Management therefore expects additional margin pressure in Q2 financial year 27 because of higher fuel and packaging cost, maintenance shutdowns, and weaker operating leverage. However, JK Lakshmi is actively addressing these pressures through renewable energy, alternative fuel usage, logistics optimizations, and price increase. The key trigger for earnings recovery will be whether these initiatives can offset the current cost inflation. The long-term investment story is supported by significant capacity expansion and lower cost energy initiatives. The expansion include additional clinker and cement grinding capacity and is targeted for completion by the end of financial year 28. The company also plans substantial capital expenditure through financial year 27 to 29, including its Northeast expansion. At the same time, the renewable energy strategy is becoming increasingly important, with renewable sources already contributing 49% of total consumption. A new captive solar and battery storage project is expected to provide lower cost power, with full benefits expected from financial year 28. These investments should strengthen the company's cost structure and support higher capacity utilization as industry demand expands. The forward outlook remains constructive despite the near-term margin pressure. The analysts expect JK Lakshmi Cements to deliver approximately 11% volume and 8% EBITDA over financial year 26 to 28. Revenue is projected to grow approximately 12% over the same period, while EBITDA margin is expected to recover from financial year 27 pressure and improve towards financial year 28. The company is also targeting growth above the expected 6 to 7% industry demand growth in financial year 27. The combination of volume expansion, improving realizations, capacity additions, and cost efficiency measures provide the foundation for earnings recovery. However, the price margin recovery remains the most important factor to monitor, particularly given the expected increase in fuel cost during the near term. Putting the complete picture together, JK Lakshmi Cements remains buy opportunity. The near-term earnings environment is challenging because of elevated fuel, raw material and packaging cost, and the analyst has consequently reduced its financial year 27 and 28 EBITDA estimates by approximately 3% and 5%. However, strong volume growth, improving pricing, geographical optimization, renewable energy initiatives, and capacity expansion provides meaningful long-term growth drivers. Thank you for listening to this video. Thank you for sparing your valuable time. Happy investing.